This is by far my favorite part of this course, and I'm sure it'll be yours too as well. We are finally talking about return, the money we make. This is the interest that we earn on all of our loans. Far too many Americans have told me that they fell into the bad habit of not even opening up their monthly retirement account statements because they couldn't stand seeing the losses anymore. Well, that's a thing of the past from here on out. From now on, you will know exactly how much you're going to make every single month without even having to open up that statement. Let's explore how we make money and how we get paid just like the banks do. At the end of the day, all of our evaluation of investments boil down to two words: risk and return. Being a private lender on trust deed mortgages requires us to be able to determine what the return is and make sure that that return is commensurate to the risk we face on any given lending opportunity. The higher the risk, the higher the interest rate we should receive, and correspondingly, the less risk, the lower the interest rate. Let's dive into how we determine our risk versus return as a private lender. Now, as a private lender, we already know that there's a reason why they're coming to us for this loan and they're not going to the big bank on the corner. The loan itself probably isn't a cookie cutter deal or a slam dunk. There's going to be a certain amount of risk associated with the loan, and that is where we choose the rate of interest that we're going to charge for partaking in that lending opportunity. Therefore, we must make sure that we are protected first, regardless of how experienced or inexperienced our borrower is. That's why, as a private lender, we mitigate our risk and base our lending criteria on the strength of the collateral, more so than the creditworthiness of the borrower. So I repeat, we are focused on making sure we're protected with collateral rather than the creditworthiness of our borrower. The interest rate on a loan opportunity is determined by you, the lender. Obviously, it has to be reasonable, or the borrower would never agree to pay an interest rate that is too high or more expensive than rates that he could receive elsewhere. The interest rate on the mortgage is the money you can make, generally represented as an annual percentage rate. A trust deed investor can easily expect to earn between 5 and 12% on any given loan that has a solid level of collateral. Remember that the borrowers of this money are generally expecting to make anywhere from 20 to 50% returns on their investment, and that is what allows them the opportunity to be able to afford such a high interest rate from you, the bank. The majority of trust deed loans are interest-only loans. Interest-only meaning that the borrower will only be paying the fixed interest monthly, without paying any additional money to pay down the principal that's put up by you, the bank. The principal is then returned in one large lump sum or balloon payment at the end of the loan. On an interest-only loan, monthly interest can be determined by simply taking the interest rate and dividing it by 12. That number will be what you can expect to receive as a monthly payment every month that goes directly into your bank account or your self-directed IRA. For example, if you lend $100,000 at a 12% interest rate on an interest-only loan, you would be making $12,000 in the first year just in interest. Since all mortgages pay monthly, you could take that $12,000 or that interest rate of 12% and divide it by 12 to easily know what you're going to be making every single month. So in short, that $100,000 loan at 12% will bring you 1% a month, or $1,000 monthly right back into your bank account or right back into your self-directed IRA. So let me say it again to make sure that everyone is clear. The source for your capital that you choose to use as a bank, it can be either cash or it can be retirement money like IRA and 401k funds. When you lend cash, the interest and monthly payments you receive will go directly back into the bank account or you'll be cut a check. You will be responsible for paying taxes on that income at the end of the year. Of course, if you have a question on how they're going to be taxed, please consult with a CPA or other tax professional. But if you invest from an IRA, that interest again goes right back into that IRA, tax penalty free, and is in there for you to be able to reinvest on the next loan without ever facing any tax penalties. When investing and planning for your financial future, don't make the mistake of asking the question, how much money am I going to make on this investment? Because I've learned over the years that a wise investor always asks the question, how much money can I make on this investment after taxes? That is what all of you should be thinking as well. The goal for any investor should be able to minimize the amount of taxes he has to pay. Money saved is just as good as money made, so let's keep that money in your own pocket as opposed to handing it over to the IRS. Private lending should be done as much as possible within a self-directed IRA, simply for the tax advantages. Paying less taxes and deferring taxes provides you more capital to reinvest. If you had a loan pay off and it returned you a total of $100,000, do you want to give the IRS 20% of that? Of course not. You'd rather reinvest the whole amount of money so that way it can grow and compound greater and greater for you. It's a no-brainer. Imagine doing it with the Roth IRA. Any money you invest and make an interest will be money you never have to pay taxes on again. So you can take an account and grow your Roth IRA from $2,000 all the way up to $1 million, and you will have only paid taxes on the $2,000 that you started with. So whether you utilize cash or retirement accounts, you can potentially know exactly how much income from interest that you're going to receive every single month right back into your bank account or IRA. Imagine that, getting your IRA statement in the mail each month and already knowing how much your account has grown. And you're going to know exactly the day each month that the money's going into it. That is hard for so many of us to imagine after what we've been having to deal with in the stock market over the last decade plus. I know tons of people who have reached the point where they wouldn't even open their statements anymore to avoid the frustration of having to see that no matter how hard they worked that month, that they could potentially have less money at the end of the month than they did at the beginning. That never has to be you again. With private lending, you control how much money you earn and how often you earn it. You now understand how to make consistent, safe money every single month and be the bank. In our next section, we're going to discuss the fundamentals on evaluating risk on a potential lending opportunity. That way we can make sure that we protect that money that you're now making.